Are oil stocks the buy of the century? Not too long ago, oil was the talk of the investment YouTube space after future prices went negative for a day. But after a low period, many investors are looking at the commodity as an opportunity. While I made a video not too long ago explaining how oil is a poor long-term bet, with prices like these, I think there are some serious opportunities in the near term to make some great returns on companies like Exxon Mobil. The factors driving prices are well explained in this quick Dan Yergin interview with CNBC. Here's the clip.
Obviously, this has been a pretty crazy year for oil prices. We saw that huge decline as the world economy shut down because of the virus. What's going to be driving things as we head into next year? Is it still the virus front and center?
It's absolutely the virus front and center, and the vaccines. And you can see in China where the vaccines are, people have been vaccinated and they've dealt with the virus. Oil demand is actually higher than it was last year. But the number one thing out there is how long is it going to take to get the vaccine out to people? And that will get oil out of this $40 to $50 range.
Out of the $40, $50 range to where?
Well, I think it's reasonable to think that a $50 to $60 range is what you'll be looking at. And you'll see world oil demand probably by the end of 2021 or 2022 back to where it was in 2019 before this all started.
In today's video, we look at some recent developments and I reveal my option position in the company, a bet that can earn you thousands of dollars by summer 2021. Exxon had a shocking announcement very recently. If we head over to their investment relations page, there is a headline on the front page there labeled Prioritizing Capital Investments on High Value Assets. This may sound boring, but reading over it, it reveals a future that looks quite bullish. The first bullet point explains how Exxon is going to use 16 to 19 billion in 2021 and 20 to 25 billion annually until 2025 as investments in exploration. This may sound like just a figure, but it represents about a 30% reduction in capital and exploration investments, an indication that oil output will be reduced for the near future. If a giant like Exxon is doing it, you better believe that the market is likely to follow. So while we could have a reduction in demand, the supply in oil is also dropping, meaning that crude prices in the near term could easily go up as supply constraints. You get a sense of this effect rippling throughout the oil world in this CNBC clip.
What would you say is the diagnosis for the oil market today?
Well, I think what we're seeing is continuing dynamics with OPEC Plus exercising some discipline. There's still a little bit of a hangover from the inventories that are out there. And of course, coronavirus is dampening demand. So those three things are all real important in driving the oil price as we see it going forward. And right now it's in the 40 range. That's probably not sustainable long term, but it's probably where we are for a while.
So do you think in the long term the sustainable price is higher?
Yeah, absolutely. There's just at today's oil price, at $40 oil price, that's not strong enough incentive to get production growth that's needed for the world and the world demands. So we're probably seeing long term something in the 50 to 60 range.
Exxon could easily produce double the amount of oil they currently output, but this rise in supply would absolutely destroy crude oil prices. It's in everyone's favor to keep prices elevated, and OPEC, the pseudo-Federal Reserve of oil, is also having a very important meeting coming up in which it's estimated they will enforce another cut in production, further reducing worldwide supply. On top of this, if we move down, we can see that Exxon is also doing a lot of cost savings. This includes a global workforce reduction of 15%, further proof that output/production will be reduced. A look around the world reveals the same thing. Oil giant Saudi Aramco is reported to be reducing capital spending by 50%, and this trend will have some serious impacts on the oil supply around the world. While we could spend hours in this video talking about the ins and outs of the oil industry and how these stocks are priced, what it essentially comes down to is crude oil price. Right now, a barrel of crude oil sells for $49. This is about the average for the past 20 years. Oil giants like Exxon, Shell, and Marathon predict that future prices should hover around $60 a barrel. These estimates are incredibly important as these figures are what essentially dictate how profitable these businesses are. Other estimates around the world are slightly lower, so in the short term, the price of Exxon essentially comes down to one question: can crude oil reach that $60 estimate and stay there in the short term? The factors that influence that question come down to a couple of things. The most important is the upcoming OPEC meeting, which is scheduled to occur January 5th, 2021. If OPEC countries can agree to a cut, you can bet oil is going to shoot up even further. This jump in price will surely push Exxon stock 10, possibly 20%. But as with previous OPEC meetings, countries are constantly arguing with each other, and getting leaders to cut production is hard, as each country tries to push their production quotas up for their own self-interests. Then there's this large republic run by this guy. Russia is the third largest producer of crude oil in the world, and guess what? They are not part of OPEC. So while everyone cuts, the Russians can always prey in the market using low supply and higher prices to expand production and profit behind everyone's back. Earlier this week, the Russians had agreed to boost production by 500,000 barrels, which is still much less than the originally planned 2 million. This event, along with the discovery of the new coronavirus strand in England, has made oil prices trend down in recent weeks. This careful balance of demand and supply is essentially going to be a battle of coronavirus recovery news, vaccine news, and oil production updates. It's my opinion that demand and supply will surely be out of sync, and that any pop in movement and coronavirus recovery is going to cause crude prices to shoot up. The vaccine effectiveness has yet to be seen, but right now, I believe that we have reached the worst of the coronavirus, and moving forward, it will only get better. As spring comes and the vaccine begins to have instant impacts on the number of cases, a giant pop in travel, tourism, and business will surely follow, and I'm betting that the supply is going to have a hard time keeping up with a crazy spike in demand. Just as we saw some wild volatility to the bottom this past summer, we're going to see some volatility to the top this next one. If we get oil prices above $60, you can bet that Exxon stock is going to skyrocket 50, 60, maybe even 70%. This brings me to my final point. How do I profit if I believe this hypothesis? Right now, I'm building a position in Exxon Mobil via call options. As of the making of this video, I have 8 July 16th, 2021 call options with a strike price of $60. I paid an average of 85 cents per contract, and I'm slowly adding more and more with every dip. Typing this position into options profit calculator, we can reasonably see what to expect if my prediction is correct. If OPEC cuts by the end of January, we can expect prices to jump, and Exxon stock will follow with a 10 to 20% rise, earning us a nice 136% return. If you're joining me along in this play, please comment below. I want to hear your story and how many contracts you are buying. Thank you guys for watching. Please make sure you hit that subscribe button if you enjoyed.